Hello and welcome to MF Corner. I'm Sonal Bhutra in the Mumbai studio. And today we are going to put spotlight on the debt market. Flows in debt funds have dropped to 42,000 crore rupees in May. The Reserve Bank of India also maintains status quo on most of the rates and other aspects as well. So let's try and understand and take a deep dive into debt funds. What explains the trend? Is it still a good time to invest in debt funds because the rate cuts, they have been pushed to later months? And what is the favorable scenario amongst investors as well? To discuss this and more, we have with us Mohit Gang, Chief Executive Officer at Moneyfront, and Deepak Agrawal, Chief Investment Officer, Debt at Kotak Mahindra AMC. Gentlemen, thank you so much for joining us today. And you know, debt is a category generally that we find it a little complex, and investors find it a little less interesting versus the equity markets. So it's always good to get in experts to understand that as well. So thanks a lot for joining us today. Deepak, let me come across to you first up. And since flows are the most recent data that we got, debt fund flows have been quite volatile. Can you explain the mood of debt market right now? What explains all of it right now?
Yeah, thank you for having me on your channel. See, basically in the month of May, the flows were volatile in the cash segment, which is the liquid and overnight segment. That is largely attributed to the tight liquidity in the banking system. The liquidity in the banking system had dropped on account of huge government balances and also on account of increase in currency in circulation. Now the new government has been formed and we expect spending to resume. So over the course of next 2 months, we should again see inflows into the cash segment. But all this while, we have seen inflows in the liquid plus category, which are largely ultra short-term money market. The yield curve is steep, and these portfolios have relatively higher portfolio yield. So we have seen inflows in these funds, and the flows in rest of the category has been more or less stable.
Okay. Mohit, coming to you now, because we did see that negative flow in the month of March. Then April did see big inflows. Of course, there was some year-end activity as well, but these flows have come down again in the month of May. What explains that?
Look, thank you very much, Sonal, for having me on the show. I think March was more seasonal in nature. March is, I think, the year-end period where most of the corporates typically would want to have cash on the balance sheet and for their own financial requirements in terms of balance sheet dressing and everything. I think typically March always sees a redemption out of liquid funds and overnight funds. April, I think it was mostly plowing back of the same amount of money. So if you see the March outflows and equate it with April inflows, I think more or less the numbers are almost identical. May the numbers have been a little low on the debt side, but the liquid flows have been fairly strong. The liquid and overnight flows are both very strong. The other categories of debt, as Deepak rightly mentioned, haven't seen too much of inflows as yet. Look, my sense is there are multiple reasons to it. I think a whole generation of new age investors post-COVID haven't experienced great returns on the debt side. They've only been witnessing one-sided bull run in the equity markets, and which is also what is dissuading most of these investors from getting into debt funds. Also, the taxation change, which ushered in last year, has made a huge impact on the debt fund flows. So as an investment vehicle, debt funds have actually lost a lot of ground and a lot of sheen. And the third reason perhaps is that a little bit, I would say, lack of awareness in terms of how debt can also make phenomenal returns if the interest rate cycle is likely to reverse. So I don't think so investors are yet fully aware of the scenarios in which debt can also give you superlative returns. So I think a combination of whole host of these factors is what is resulting in the numbers which we are seeing.
Okay, all right. So that explains what we've been seeing in last couple of months. And also important to understand, right? Because we do see big swings coming in this particular category. You mentioned rates. So let me take that question now to Deepak. Because now there is a possibility, Deepak, that rate cuts could be pushed further. Do you think the attractiveness of debt funds in that case could possibly come down? Because it's an inverse relationship, right? If interest rates go down, we see debt prices going higher. So what happens in this case now?
Again, if you look from the RBI latest policy was more or less similar to the April policy, where RBI kept the rate unchanged and the stance was also maintained as withdrawal of accommodation. However, the positive this time was two members voted for a rate cut of 25 basis points, Professor Jayant Verma and Dr. Ashima Goyal. But in spite of the policy being more or less stable for similar over last 2 months, we have seen long-term yields trending lower by 5 to 7 basis points. So investors who have increased their duration, let's say over the course of last 3 to 5 months, have actually benefited because the interest rates are trending low. Now, the next policy of RBI is in August. By August, RBI will have clarity on three things. One, monsoon. Second, the budget. And third, the Fed likely outcome. So we have the Fed meeting next week, where we expect Fed to reduce the dot plot to 50 basis point rate cuts this year and continue to guide for 75 basis point rate cut next year. Regarding monsoon, the expectations are of a normal monsoon. So by August, RBI will also have comfort on the food inflation front. And third, on the budget side, even after, let's say, government has received additional 1,25,000 crore worth of dividend from PSUs and RBI, even if they increase their expenditure or tweak their expenditure mix, we still believe that the fiscal deficit for FY25 will be pegged anywhere between 490 to 5%. And fiscal deficit, they'll continue to guide fiscal consolidation, where fiscal deficit for FY26 will be pegged at 4.5%. So we assign a high probability that RBI is likely to change stance either in the next policy or after that. And we continue to expect at least 50 basis point rate cut over the course of next 1 year, starting October 2024 onwards.
Okay.
In addition, the liquidity which has been tight is likely to get easy over the course of next 2-3 months, which will benefit along with rate cuts the shorter end of the curve. So we believe the attractiveness of the debt fund continues, and investors should select fund based on their risk appetite and their time horizon.
Okay, all right. So 50 basis points cut is what you're expecting starting October in the next 1 year. And that is the big question, right? When will RBI cut rates? We do, of course, have the FOMC meet outcome that we are waiting for tomorrow as well. Mohit, same question to you. How do retail investors understand this, right? Because usually it's said rates are getting cut. Maybe it's time to go for debt funds. How do you explain that now?
Sonal, I kind of concur with what Deepak has said. Rate cuts are imminent. However, you can always debate whether it will happen in a quarter or 2 quarters or perhaps the start of next calendar year, right? So they've got pushed down a little, which is true. But we also see ECB cutting rates by 25 bips, which is as late as last week, right? So the cycle perhaps is almost there to turn. When that happens, all your long duration funds, Sonal, they are the ones which benefit the most, because as rates reduce, the longer the duration of the fund, the better or higher the capital appreciation in the fund is. Today, if you see, the yield curve is almost flat. Right from the shortest end of the curve, which is roughly at around 710, 720, to the possible 10-year bracket, which is again in the same band, right? So the yield curve is almost flat. But as you see rate reduction coming in, kicking in, I think the yield curve should take a normal shape, and you should see investors investing into long duration funds or gilt funds benefiting the most. So my sense is it's a great entry point for all those investors wanting to invest in debt with a 2-3 year kind of a view. I think to my mind, double digit returns are fairly likely if the rate cycle reverses by at least 1% in next 2 years.
Okay, all right. So it's a good time to enter if the rate cycle reverses by 1%, or sorry, 2% in next 1 year. I got confused there, Mohit.
So by minimum 1%, if the cycle reverses by minimum 1% also, then the double digit returns are fairly likely in long duration debt funds over the course of next 2 years.
Okay, all right, got it. Deepak, let me come to you now, because there's one more category that we don't talk about so often, and it's important to understand that as well. What is a good time to look at floater funds, and how do they differ from normal funds?
Floating rate fund invest 65% of their portfolio either in floating rate assets or in synthetic floaters. Now, what are synthetic floaters? Synthetic floaters are fixed rate instruments which are converted into floaters using derivatives like interest rate futures and interest rate swaps. So typically the perception is that floating rate funds are likely to do better when interest rates are heading higher or where inflation trajectory is supposed to be higher. But it also depends upon the investment strategy which the fund manager is running in his floater fund. So typically he will run a lower duration when the view is that interest rates are likely to trend higher. Similarly, a fund manager can counter the view that interest rates are trending lower by increasing the duration of the floater fund. Plus, floating rate fund also act as a hedge for, let's say, right now the world is relatively uncertain. Someday you see spike in crude oil prices from $80 to $90. So floater fund also act as a hedge to counter any unexpected, let's say, price shock.
All right, get that point. Mohit, your take here. What is a good time to look at floater funds?
Look, Sonal, our experience with floater as a category hasn't been very great, to be very honest. Though Deepak has rightly put it, I think it all depends on how the fund manager is finally managing it. My sense is the problems are many in that category. There is a lack of very good, high quality floater instruments in the Indian market, per se. You have to have a synthetic floating instrument to manage that. Plus, if it is a true sense floater, my sense is it does very well in a rising interest rate scenario or a flattish interest rate scenario. In a scenario where you are anticipating rate cuts, which is, I think, the consensus view in the market that rate cuts are likely to happen within the next 6 months to a year, then perhaps floater might not be the greatest of instruments. The transparency also isn't very great in floating rate funds out there, and it's very confusing for a normal retail investor to understand the true crux of how the fund is getting managed. My sense is investors will will be better off in case they hold on to the short end of the curve right now, because the yields are fairly elevated for any kind of short-term parking. And for a long-term view on debt, I think I would rather prefer a long-term debt fund or a gilt fund.
Okay, all right. That takes me to the next question, which a lot of investors are not sure of. Because with equities, we always say, let's do an SIP because markets will come down 1 month, the other month it will be higher. But Deepak, does it make sense for investors to do an SIP in debt funds, or should it always be a lump sum investment, not considering the rate cycle at that moment?
So we believe that investors should have a fixed income allocation. The percentage they can decide in consultation with their investment counselor. And so systematically every month they can invest in fixed income scheme in order to ensure that percentage allocation. Moreover, at the current juncture, based on our view that interest rates have peaked both globally and domestically, we have seen ECB and Bank of Canada cutting rates. RBI is likely to ease over the course of next 1 year. And in addition to that, we have index flows along with the favorable domestic demand supply, which will lead to, let's say, a drop in long-term yields over the course of next 1 year. So at the current juncture, we believe lump sum also makes sense.
Okay, all right. What about you, Mohit? What would you suggest an investor to do here?
Well, look, Sonal, I've been very clear on debt side. If you have to really make investments, you have to go lump sum. There's very little merit in staggering out and trying to time the market on the debt, or trying to even stagger out your entry price out here. I think the market cycle looks very favorable. The yields will start easing off as India's global inclusion in JP Morgan bond index also happens this month. You will see a lot of flows coming into debt market with the government continuing the policy stance, continuing the focus of government on the fiscal deficit situation getting improved. I think all of these are very favorable scenarios. The time is extremely ripe to enter into debt funds right now, and if you have a pot of money, you're sitting idly, there's no harm getting at least the accrual yield of the debt funds right now. So a lump sum is a great tool. My sense is for debt, I think that always makes sense.
Okay, all right, take that point. So we'll do one thing, gentlemen. Thank you so much for this interesting conversation and making things easier when it comes to the debt side for sure. Thank you, Deepak, for sharing your views today and joining us on the MF Corner show today. But on the other side, we'll analyze the mutual fund data that came in for the month of May with Mohit. So stay tuned for that.